In the last episode, we added salaries and built a hiring plan into the model. Now, we are completing the expenses picture by looking at the last major category, capital expenses. These are the big one-off purchases, physical assets, and technology that the business needs to operate. Things like servers, hardware, equipment, vehicles, or even property. Capital expenses are the different from operational expenses and salaries because they are not just cost in one month. They are assets that have a value over time, and the model needs to know how long you will use them and how they depreciate to properly calculate taxes for your business. To get here, you navigate to the expenses section and click on the capital tab at the top. When you arrive on the capital expenses page, the first thing you see is the capital expenses forecast chart. This is a visual summary of when you are spending money on capital assets and how that spend is distributed across your 5-year forecast. Below the chart, you will find the department breakdown, which shows you how capital expenses are distributed across your business. And you can switch between this month, this year, next 12 months, and the full 5-year total view. If you switch to the planned expenses tab, you get a clean summary of every capital asset already added broken down by tab. You will see tangible assets, which are the physical things you can touch like hardware, equipment, and property, and intangible assets, which are things like intellectual property, software licenses, or patents. For each category, you can see total planned capital cost across all 5 years. So you have a clear picture of where the major investments are going and when. Now, let's add the new capital expense alongside that. Let's click Add Capital Expense at the top of the page. The first step is to choose the category for the asset you want to add. The drop-down gives you a range of options that cover the most common types of capital investment a business might make, like buildings and real estates, equipment, technology and hardware, or more. We are going to choose technology and hardware because we are adding servers and networking equipment that the IT team will use. As soon as you select the category, you will notice something at the top of the right of the form, a depreciation method selector, set by default to straight line depreciation. This is an important concept, so let's explain it briefly. When you buy a £15,000 server, usually for the tax purposes, you don't just record it as a £15,000 cost in 1 month. You spread that cost over the useful life of the asset. Straight line depreciation is the simplest way to do that. It divides that 15,000 cost evenly across the number of years you expect to use the asset. So a 15,000 server used over 3 years would create a depreciation cost of £5,000 per year, or around £416 per month. This is what happens on the paper. In reality, you still need to spend 15,000 today to purchase that asset. But don't worry, the model handles all the calculations for you, so you just need to provide the right inputs. Let's choose the specific type of expense within your category. For technology hardware, the options include things like server and networking equipment, security systems, firewalls and intrusion detection systems, and many more. We are going to select servers and networking equipment because that's what we are planning to buy. Once you select it, a company name field appears. Here we've entered Dell Technologies as the supplier, which make it easy to identify this asset later, the same way we did with the cost of sales or operational expenses or salaries. Below that, you will see the department name, which is automatically set to the information technology for this type of hardware. But you can change this if the asset belongs to a different part of the business. Then, you answer a simple but important question. Do you already own this expense? This determines whether the asset is already on the balance sheet or whether it's a future purchase you are planning. In our case, we are planning to buy it, so we select no. When you select no, a new field appears. When will it be purchased? Which tells the model exactly when this cash will leave the business and when the asset will start to appear. Next, you enter the cost of the asset. In our example, £15,000 for the servers and networking equipment. Below the cost, you will see the same VAT options you've seen in other parts of the model. You can choose the include VAT in the price or exclude VAT from the price, depending on how you've quoted the cost. Then comes one of the most important fields. How long do you expect to use this asset for? This is the useful life of the asset, and it directly controls how depreciation is calculated. Next to that, you can also enter an asset value after 3 years. For most technology hardware, this is close to 0, so we left it at 0. Below the asset details, there is a financing section. Here you tell the model how you plan to pay for this capital expense. There are two options. Cash, meaning you pay for it upfront for your existing funds or future investments, and loan, meaning you finance it and pay it back over time, which would involve additional interest and repayment assumptions. For this example, we've selected cash, which is the simplest option and means the full £15,000 will come out of the cash balance in June 2026. Once you click Save, you are taken straight back to the capital expense dashboard, and you can immediately see the impact on the capital expenses forecast chart. The bar for 2026 is now noticeably higher than before, reflecting the 15,000 server purchase, sitting in June 2026. Alongside the other hardware already in the model, those costs will be visible over here. If you switch to the planned expenses tab after saving, the summary shows how total planned capital expenditure has changed, and you can see the year-by-year breakdown for both the existing asset and the new server purchase. So in this episode, we've added a capital expense for servers and networking equipment, a planned £15,000 purchase in June 2026. It will be depreciated over 3 years using straight line depreciation and financed with cash. Together with operational expenses and salaries, this completes the full expenses side of your financial model. You now have a model that covers revenue from your products and services, cost of sales to deliver those products, operational overheads, operational expenses like insurance and software tools, salaries and your hiring plan, and capital expenses and their depreciation. All of those feeds into your burn rate, cash balance, runway on the summary dashboard. Therefore, in the next episode, we'll move to talk about how all of those pieces of your financial model come together on the summary dashboard. What your numbers are really telling you about cash burn rate, runway, how this set you up for making investor-ready decision.